This video will describe the contents of the Business Valuation Report, one of 6 reports provided by the Fiscal Checkup software. The focus of this report is to summarize the methods and approaches that are used to calculate the fair market value of a business. Because we do not physically visit the company, this report serves as a calculated value of a business. The first page starts with an overview of the methods and some conclusions. The first section summarizes the primary approaches to determine the value of a company, including the process to validate and cross-check the value that has been estimated. The bottom half of the page first summarizes the 4 critical inputs needed in order to calculate the value of the business. Then it shows the estimated fair market value calculated by the software. Page 2 contains a summary of the adjustments to the financial statements. The first table lists all of the adjustments to the income statement that were entered into Fiscal Checkup. The income statement used for evaluation must represent the true earnings capacity of a company. For a detailed description of each of these adjustments, we recommend you view the recording of a webinar on our website entitled Business Valuations. The table continues listing the adjustments to the balance sheet. If the assets have been written down with accelerated depreciation, then the balance sheet must be adjusted to reflect the current value of the assets. This table concludes by calculating the excess or shortage of working capital in the business compared to their industry. As you can see on line 11, this company was short on working capital in 2013 and 2014, but in 2015, they now have more working capital than is customary in their industry. The bottom of the page presents the income statement as it was prepared by the company, but we've added line 23 in order to include the income statement adjustments that were entered into Fiscal Checkup. Page 3 calculates the discount and capitalization rates, in addition to estimating the future free cash flow, also called owner's discretionary cash. The first section graphically shows how the adjustments to the financial statements impacted both EBITDA and book value. This discussion describes how the discount rate was calculated. It's comprised of 3 components listed on line 26, 27, and 28. The discount rate will be used to calculate the value of the business using the discounted cash flow method. The growth rate of profits is deducted from the discount rate in order to arrive at the capitalization rate, which will be used in the capitalization of earnings method. Finally, the process of estimating the free cash flow is shown for the next 3 years. Free cash flow is also sometimes called owner's discretionary cash or ODC. The bar chart shows the free cash flow calculated by the software for 5 years. The software also estimates the terminal value of the business in year 5, and it's listed here in the narrative. The terminal value is the expected value if the business were to be sold, which would be included in the cash flow at the end of year 5. Again, the process that we're going through here is explained in depth in the valuation webinar listed on the Fiscal Checkup website. Page 4 contains the estimates of fair market value using the 3 primary methods of value. Using the discount rate and the estimated free cash flow, along with the terminal value of the company in 5 years, the software calculates the value using the discounted cash flow method. After adjusting for debt, growth, and taxes, the capitalization rate is used to calculate the value of the business using the capitalization of earnings method. The software uses the multiples of public companies in the same industry to calculate the selling value using the multiples of EBITDA, book value, and earnings approaches. Finally, the software calculates an average, blended market selling value. The report then shows how the market comparables that were used for this company compare to the entire composite index assembled by Fiscal Checkup, as well as comparing the composite index to the New York Stock Exchange. Page 5 completes the process of estimating the fair market value and the appropriate range of value. Then the validation model validates a buyer's expected return on equity. The first table weights the values calculated by the different methods in order to arrive at the fair market value of the company. Then the value is adjusted to compensate for the balance sheet adjustments entered previously. Finally, if the company has debt, the debt is deducted to arrive at the fair market value of the equity. A valuation range of plus or minus 10% is then provided. The value calculated by the 5 different approaches are presented here graphically, as well as the weighted average fair market value. Note that this is before the balance sheet adjustments are added back in. The final table on this page goes through a process to validate the fair market value that was calculated. To do so, we assume that the business was sold with 30% equity and 70% debt financing. We then calculate the buyer's return on equity that was invested. We generally look for a return on equity of 20 to 30% in order to validate the fair market value of the business. If the return was over 30%, it would suggest a value closer to the higher end of the range provided. If the return was below 20%, it would suggest a value closer to the lower end of the range provided. Another check on the fair market value of the business is to look to see if a prospective buyer can earn a return on invested capital that is in excess of the weighted average cost of capital. When the return on the invested capital exceeds the weighted average cost of capital, it means that this investment provides for a positive use of funds. Finally, the reader is reminded of the excess or deficit of working capital in the narrative above the table. Page 6 reviews year-over-year changes in the financial statements. The first table discusses year-over-year changes to the income statement. The second table describes the year-over-year changes in the balance sheet. And the third table shows the changes in the cash flow statements. Page 7 reviews the financial statements and provides insight on the future viability of the company. At the top of the page is a discussion on what has happened with sales and margins, as well as some discussion of the market that the company participates in. The most significant accounts from the income statement are summarized here, followed by the most significant accounts from the balance sheet. Since the V, or viability rating, was used as a component to help calculate the discount rate, the analysis of the subject company is presented on the bottom of the page. Since the business valuation often contains terminology not completely understood by all users, this report contains the definitions of 12 terms used in the valuation analysis. For each report, there's the ability for the user or business advisor to add comments. If any were entered, they are listed on the final page of the report. Thank you for watching this video. If you have any questions or suggestions, please call or email us.